Assalamualaikum warahmatullahi wabarakatuh. Good morning, sir. My name is Sapira Sapia Andriani. I'm from accounting class D. This is my video record about account, debits, and credits. The previous chapter shows how transaction cause financial statement amounts to change before and after examples. Was used to develop the illustration. Imagine if a real business tried to keep up with its efforts this way. Perhaps a gift board could be set up in the accounting department as transaction occurred. They would be called into the department and the board would be used cost-fold quick rule. Even if the business could manage to figure out what is transaction that produce those results, obviously a system is needed. It is imperative that a business develop a reliable accounting system to capture and summarize its voluminous transaction data. The system must be sufficient to follow the preparation of the financial statement and be capable of maintaining retrievable documentation for each and every transaction in a system where transactions and events are reliable, processed, and summarized into useful financial statement and reports. Whether this system is manual or automated, the heart of the system will contain the basic processing tools, account debits and credits, journals, and the general ledgers. This chapter will provide insight into this tool and the general structure of a typical accounting system. Accounts. The record that a cap for the individual asset, liability, equity, revenue, expense, and dividends components are known as account. In other words, a business will maintaining an account for cash, another account for inventory, and so forth for every other financial statement element. All accounts image the general leaders as nothing more than a notebook. With a sports fact for every account, this you call thumb through the notebook to see the ins and outs of every account as well as exchange balance. An account called simple the following. This account reflects that cash has a balance of January, and examining the account, you can see the various transactions that cause increases and decreases to the beginning of month's cash balance. In many respects, this cash account resembles the register you might have for cash for the indicated amount. Without a doubt, you have heard of seeing a represent to debits and credits. First, you have had someone credits your account, or maybe you have used a debit card to buy something. Debit of credits abbreviated CR are unique accounting tools to describe the change in a particular account is necessitated by a transaction. In other words, instead of saying that cash is increased or decreased, we say that cash is debit or credit. This method is again restricted to physiology, and Franciscan monk who is given credit for the development of a and during accounting. The fallacy of flash and mean nomenclature. The second observation above would not be true for in a increases decreases system. For example, if services are provided to customer for cash, but cash and revenues will increases. Account payable. Finally, some transactions are mixture of increases, decreases, purpose capture. The whole culture was used for the various illustration. As you can tell by reviewing the illustration in part 1, system lacks internal consistency. Thank you, Share.